Hello everyone. In this module we are going to look at an introduction to financial markets, the different types of assets which can be traded on those markets, as well as some of the participants and intermediaries who are participants in those markets. So let's have a look at the overall function of the financial system. In general, the financial system allows entities, so both individuals and institutions, to borrow money, to raise funds, also to invest and save those funds. Businesses can issue equities representing ownership in the business. Risk can be managed through hedging and other methods. Assets can be exchanged. And also, those who have information can use that information in order to generate returns, while always staying on the right side of insider dealing laws, of course. When the market is liquid and well participated in, the equilibrium rate will be arrived at, which equates savings and borrowing. So there will be an equilibrium where savers, investors are happy to accept the rate of return, and borrowers and those who raise finance are happy to issue finance at that cost. And through the wonders of market forces, capital should be allocated efficiently to the most efficient and highest valued uses. Now, the functions of the financial system will benefit various parties. So an investor, that's somebody who has some cash to invest at the moment, they're going to invest that cash in equities or debt securities or perhaps alternative securities as well in order to earn that equilibrium or fair rate of return over time. An information trader, one who has information about, or at least they think they have information about how securities markets are going to go, well, they're going to hope to earn positive risk-adjusted returns, so perhaps higher than the fair return via active management, seeking to outperform benchmark indices. Hedgers, well, they take a position to offset an existing risk. So, for example, if a business is exposed to a foreign currency risk, they can take an equal and opposite position in the currency derivatives market, so that if they lose on their underlying transaction, then they're going to win on their derivatives transaction, and vice versa. Now, lots of different assets can be traded and exchanged on the financial market. So let's firstly make a distinction between financial and real assets. Real assets have a physical presence. This would be things like commodities, real estate, that sort of thing, whereas financial assets are more traditional assets like equities and debt securities and currencies and things like that. Now, of course, we've just made a distinction there between debt and equity securities. Equity securities represent ownership or part ownership in a firm, whereas debt essentially is where the investor has lent money to the institution or to the individual, and they expect to earn an interest rate on it. Now, some securities are public, which means they can be traded on an exchange, so it's a lot easier for buyers and sellers to meet and to trade. Whereas private securities are not traded on an exchange. So if you own equities in a private company, an unlisted company, you are subject to a bit of liquidity risk in that when you want to come to exit your investment, you need to go and find a seller yourself, which may not be particularly easy. Now, derivatives, so these are securities which derive their value from some sort of underlying asset. Well, we talked about financial and real assets just a short while ago. So physical derivatives would be those whose underlying asset has a physical presence, like a real estate or a commodity, whereas financial derivatives underlying assets would be financial assets themselves. Now, the spot market is the market whereby assets can be exchanged with a view to immediate delivery, or at least very short-term delivery. Some spot markets are T+1, T+2 settlement. But compare that to the futures markets, which would also include forward markets and option markets, where the asset is agreed to be exchanged at a specified date in the future. Primary markets are those where the securities are newly issued. So if a company wants to issue some more shares, then it will issue those shares on the primary markets. Whereas the secondary market is where previously existing shares are traded between buyers and sellers. Call markets, these are where assets are only traded at specific times. whereas continuous market trading happens at any point while the market is open. A specific distinction between money and capital markets. Money markets is for debt securities less than 1 year, whereas capital markets would be for equity and debt securities with a maturity of greater than 1 year. And then finally, traditional markets are traditional asset classes such as debt and equity. That's where those securities are traded. And our alternative investment markets, more alternative assets, of course, so things like real estate and commodities. Now, the distinctions we've looked at over the last few moments, they're not standalone. So there's a lot of overlap between those markets. So some traditional markets are money markets or capital markets, primary and secondary markets as well. So just quite a lot of definitions here for you to be comfortable with as you go in towards the exam. So what types of assets can be traded on these markets? Well, we've already referred to a few of them. So equities represent ownership, so shares in a firm, whereas fixed income securities are debt securities. So if you buy a bond in a company, you don't actually part own that company, but you are entitled to a series of fixed cash flows into the future. And of course, assets exist that aren't in a specific individual company. Instead, these are pooled investments. So this is a type of fund where they combine many investors' funds together to invest in other assets like equities and debt. So various examples of these pooled investments exist. So mutual funds, which would include a real estate investment trust. So you can buy a share in a mutual fund, and that's your funds going into the pool, and the fund manager will then make direct investments in equity, fixed income, real estate in order to generate a return. An exchange traded fund is very similar. One of the specifics about ETFs is that shares in the ETF can be exchanged for the underlying portfolio assets and vice versa. Asset-backed securities give the holder a claim to a portion of financial assets, like mortgage debt or credit card debt. Hedge fund, slightly higher risk. These are often highly leveraged, and the fund manager will take a performance fee based on the performance of the fund. Carrying on then, currencies, fairly self-explanatory, but you can exchange all sorts of currencies on the financial markets, not just the most popular ones, but of course the global reserve currencies like the US dollar, the euro, the yen, they'll have a lot more liquidity in the market. Now, a contract is simply an agreement between two parties, and there's various different types. An agreement between two parties to transact or to take certain actions in the future. So a forward contract and a futures contract are very similar. Futures are simply exchange traded forwards, but this is where two participants agree to buy or sell a specific asset at a point in the future at a price that's agreed today. A swap is an agreement to exchange a series of cash flows in the future. An option is where the holder of the option has the choice to enter into that transaction rather than the obligation. And insurance contracts allow market participants to manage their risks. Commodities are physical assets. These would include metals like base metals and precious metals, agricultural assets like wheat and orange juice, and also energy like oil and gas. Real assets are those with a physical presence, so real estate, equipment, and machinery. Now, in the financial markets, there's various types of intermediaries that exist, and the intermediary's job really is to connect buyers and sellers. Important that you understand the differences, really. So a broker is an intermediary that will connect a buyer and a seller of an asset, of a security, at exactly the same time. So the brokers won't hold inventory of those assets. They'll simply connect the buyers and sellers so that they can transact with each other and of course charge a small fee for the privilege. Really, that's the same role that's carried out by the exchanges. So more liquid securities don't really need brokers or market makers standing in the middle, and instead buyers and sellers would place their orders directly with the exchange and they'd be automatically matched. Now, a dealer is very similar to a broker. They're still matching buyers and sellers of the same security, but at different points in time. So that means that the dealer will hold an inventory of shares so that they can buy, I say shares, it could be any asset, but they can buy the asset from the seller, hold on to that inventory until they sell it on to another buyer. Now, arbitrage is where they participate in two different markets, but in the same security. So if a security is on sale in two different markets at different prices, the arbitrageur will make a profit by buying in the cheap market, simultaneously selling in the more expensive market, and then pocketing the difference as profit. Now, arbitrage opportunities are less and less available the more liquid the market, because if there's free money available, then lots of people will identify that and do it at the same time, and the forces of supply and demand should mean that the arbitrage opportunity is eliminated fairly quickly. Now, securitizers, well, they bring a pool of assets together. So they'll pool assets together, like credit card debt, like mortgage debt, and then sell interests to investors. Insurance companies, well, they do manage a diversified pool of risks, but it does mean that market participants who want to manage or hedge some of their financial or other risks, they can take out insurance contracts. The insurance company, of course, overall will make a profit on all of their insurance contracts, but individually, it allows individuals and institutions to manage very high impact but low likelihood risks. Clearinghouses, well, they reduce counterparty risk. Clearinghouses and exchanges go hand in hand. So one of the benefits of trading on an exchange rather than over the counter is that both the buyer and the seller can remove their counterparty risk. That's the risk of the other party defaulting on the trade when it comes to settlement. The clearinghouse exists on the exchange to prevent that happening. So buyers and sellers on the exchange can have full confidence that even if the other party defaults, the clearinghouse will fulfill their obligation. They also promote market integrity by holding client securities, giving buyers and sellers assurance that the inventory of securities is there to transact.